Welcome to Making Money with Matt McCall. How are you? This is Matt McCall. We got a big show coming up. It is Tuesday, December 7th. It's almost the end of the year. It's almost Christmas time. And maybe we just happen to have some bargains for you in the market right now. Tech stocks have been absolutely taken out to the woodshed the last couple of weeks. We've had interest rates drop. We've had all kinds of news with COVID and everything else in the world going on. Lots to cover in today's show. But most importantly, we're going to get to the bottom of this. What is driving growth stocks lower? And more importantly, what stocks out there are now great buying opportunities? All this and more coming up right now on Making Money. We had a good start of the week. Monday was a heck of a day in the market. Heading into this week, though, last week was a wild ride. We had some really big up days, some big sell-offs along the way. And we're going to take a look at the charts because I think that's probably the best way to really dive into where the market's been. And we've seen a bit of a divergence between some of the bigger non-growth stocks and some of the smaller growth stocks. Even within the Russell 2000, the small mid-cap index, we've seen a bit of a divergence between growth and value within that index itself, within the small cap space. We'll talk about that as well. And then we're going to talk about Bitcoin a little bit. Big sell-off over the weekend, trying to rebound. We'll talk about where that's sitting right now. We're also going to get into some opportunities. There's some stocks out there right now that I don't know if they keep going down for a day or a week or a month, but my big picture looking at a couple of years, I see some really great opportunities in some of our high growth opportunities that are out there right now. We'll talk about some specific names coming up on the show. So let's jump into the market though. I want to show you what the market looks like right now. And we're taking a look right now at the Dow Jones Industrial Average. As you can see here on Monday, I'm actually taping this Monday night, so it's no different than Tuesday morning. But as you can see, about 646 points to the upside, about 1.9% gain on the Dow Jones Industrial Average. And we're going to get into a little bit of a chart lesson here in a minute, a couple of charts. But I just want to show you what happened here. And with this one, there is something that's pretty significant. So I'm going to actually draw a little line here just to show you. I should have done this earlier, but I'm just going to put a little support line here. You can see on the Dow, we had an all-time high in May, then pulled back again a few times. But we were making higher highs along the way. Forming a bit of a double bottom, another higher high yet, an all-time high just in November, just a few weeks ago. Pull back again to the same level. This is around 33,900. A lot of support in that area. This blue line here, just to give you an idea, it's a 200-day simple moving average. The red line is a 50-day simple moving average. So what I see here is this index between the support of the 50-day and the 200-day and the price support. You're sitting at a level right now that is pretty significant. If we hold above these lows, everywhere between 33.4 and 33.9, it actually looks really good for the index moving forward. And I'll kind of just show you where the other line came from here real quick. Right in this range, there's a ton of support, folks. So, and again, nothing's perfect. It's not as if it doesn't hold that level, boom, it's done. It could break it for a day or two. It's just the way the markets are. Nothing's that easy, not black and white. It's definitely a gray area. But it is a chart I wanted to show you, and it is an index that I thought was important. And as you can see, it had a really big day. Now let's switch over to the S&P 500, a little more broader index. Keep in mind the Dow Jones Industrial Average only has 30 stocks in it. The S&P, very similar. As you can see here, new all-time high, then we pull back. And again, I could draw a line here pretty simply to show you where the support level is at. And it's holding right near that support level. When something hits resistance and it breaks through that resistance to a high, it does a role reversal. It then turns into support. You drop in this red line here, the 50-day moving average, there's a ton of support right around that 45 to 4,600 level on the S&P 500. We closed at 45.91, up about 1.2% on Monday. And we'll switch over to the last of the major three, and this is a NASDAQ composite. It was up about 0.9%, so it lagged a bit, and it has been lagging, folks. But again, I'm going to talk about the Qs in a minute, which is the ETF that tracks the NASDAQ 100. But again, a pullback, we were just at an all-time high 3 weeks ago. So we must take everything, in perspective. Because if we start, freaking out because all of a sudden we're down 3 weeks from an all-time high, even though it might feel painful, it's just not reality. You can't really think that the market's going to go up every single day. So this is not abnormal to see these types of pullbacks. And as I'm about to show you here in a chart show in a minute, that a lot of these stocks and indexes are still well above their support level. So let's get into some of these three chart lessons I'm going to show you kind of out here. I think are important before we jump into talking a little bit more about tech stocks. So the first one I want to take a look at is the Russell 2000 index, and this is tracked by an ETF I'm looking at here, IWM. So I talked about this last month when it broke above a major resistance level. You can see it hit it so many times. That's an all-time high. Broke out, and right here it looked like a great buying opportunity. Typically that pullback to that level is a great buying opportunity. Well, it didn't hold, folks, as we know, because again, nothing's perfect. Broke back down below the major moving averages, but now we're back down to this lower support level around 210. Building a support here, back up to about 219. It was up 2.1% on Monday, so we had a big move higher on the small caps, and you can see a lot of volume in this ETF in the last 2 weeks as well. If we hold this level, I think we probably give this another run for its money. And again, I still think the small caps are going to do well. I think the small caps will outperform in 2022. And I think down here, again, it may break. I don't know. I don't have a crystal ball. That being said, because I'm a long-term investor, I think this is a nice area to be buying into small mid caps because you have the major index sitting on support. Tough to see here, but the RSI was extremely oversold, nearly at zero. Starting to turn, it just crossed above 30 for the first time in weeks. That's also a buy signal. So we have a lot going on right here. And to me, I think things look really good. The other one I want to take a look at is the Qs I just mentioned before. This tracks a NASDAQ 100. And I redrew the line in for you. Here's an all-time high. Then it pulled back, broke above that, tested support, new high again, testing support. You also had the 50-day moving average, that red line that you left what they call little tails or wicks. It traded below it, but didn't close below it. Again, this looks pretty darn good right where it's sitting right here. And that's again, this is just one piece of the story, folks, the chart. That being said, this should tell you something. I mean, that don't lose your you-know-what, because we're still in the long-term uptrend easily. We're still above price support. We're still above the 50-day moving average. The world's not ending. Again, we could pull back more, but this should just kind of calm me down, deep breath a little bit. The last chart I want to take a look at is the yield on the 30-year Treasury. And the reason I show you this is because people talk about higher interest rates, and that's going to really mess up the market. And I think that's complete BS, honestly. But as you can see here, we had a bounce back in the yields of the 30-year. This means if you're lending the U.S. government money for 30 years, they're going to pay you 1.757%. So let's call it 1.76% per year. That's extremely low. It's well below the 2.5 we're at just in March. So you can see it's pulled back quite a bit. This is a flight to safety, meaning people are buying bonds. I would never buy a bond from the U.S. government paying me 1.76% being locked in for 30 years. I think that's asinine, but to each his own. I want to go back here because the pandemic obviously hit right here, February, March, and right before the pandemic hit, the yields were around 2%. It came all the way down, well below 1, then kind of went sideways for a while, then we broke up. So right now, the yields at the lowest level since January last week. The other thing to keep in mind is we're well below where we were on the yields before the pandemic started. So even if yields get back to 2.2, which is a pretty big move from right here, but it can happen quickly, people will say, oh, yields are going back up. But in reality, we're just getting back to where we were. And with the economy back to where we were, why shouldn't we be back there now? I think we should be back there. So if interest rates go up and the Fed starts to, raise interest rates and talk about that and the whole taper tantrum, it's okay if they raise rates a little bit. We need to raise rates. And again, it might be a very short-term reaction, but overall, this is what the economy needs, folks. It shows you they were not going to raise rates unless the economy is doing well. And the economy is doing well. I don't care what you think or I take that back. I care what you think. But you have to look at the numbers. You have to look around. You can't let your judgment be clouded by political BS, because depending on what station you listen to, they're going to tell you the economy stinks. And most people who want a job can get a job. Look at the unemployment rate. Look at the job openings. Look at the people quitting jobs. Average hourly earnings going up. So there are jobs out there. I'm not saying everybody has one, but there are jobs out there. So I thought that was important to look at those charts because you want to get a little lesson from time to time. And just to give you a bit of a contrarian view, look at some of the negativity I'm about to list off to you here. The 26th of November, there was an 89.4% downside day. Down day means almost 90% of stocks were down on that day. Also on that day, the VIX, the CBOE volatility index, measures volatility. When it spikes, it's fear. It was up 54% in that one day, November 26th. That was obviously Omicron. It was the fourth largest one-day gain that we've seen in the VIX. Just a few days later, after the weekend, 11:30, November 30th, a 90.1% downside day. People just selling. It's absolutely amazing. And then we have hedge funds selling. You look at the numbers. Hedge funds are really not only selling, but taking short positions over the last week and a half. Then we have the small caps. As I mentioned before, the small cap value has been greatly underperforming growth. I have a chart here I could pull up for you real quick. Take a look. And I just did a year to date. So year to date, we have the Russell 2000 value up about 24.5%. The Russell 2000 overall, the 2000 stocks, about, let's call it 12%. And then right below that, or not right below, pretty well below that, up less than 1%, is a Russell 2000 growth ETF. So you're seeing a great laggard. And this is just from the beginning of this year. And you can see they were going hand in hand for a while. And then suddenly, boy, did it spread. Value took off. At the same time, we saw growth get crushed. They've been kind of moving hand in hand. It's tough to see this, but recently we've seen value spike back and growth really isn't going with it. So we are seeing growth once again underperform a bit. I think there's some great opportunity, as I've said before, in the growth stocks, especially the small cap stocks. So that's a chart that I think is important because I want to show you how there is that divergence, how there is money going to the market, just going into value right now. And I think that's going to be short term. I don't think it lasts that long. One other chart I want to show you, and this is one that's pretty fascinating, and this is of the ARK Innovation ETF, ARKK. It was up on Monday about 1.7%, but that was after hitting a low, the lowest level that we've seen since early November, so about a 13-month low. And if we go back to February, where at that same time the small cap growth topped out, and we just saw that in that chart, we've had this ETF, I should say, from that high down to the intraday low, down about 44%. Absolutely taking out to the woodshed. I mean, do I like buying falling knives? I don't. But I still think there's some great opportunity in a lot of the stocks that make up this ETF. Maybe not buying the ETF, but kind of scouring through there and looking for stocks that look good. Companies you feel will be much bigger many years from now, and buying at a discount. One thing I want you all to remember is when I say it's something a buying opportunity, again, I am not a trader. I'm not looking for a 2-day play. I don't know where it's going to be in 2 days. Nobody does, in my opinion. Yes, you could use the charts on minute charts and try to figure that out. But to me, I find it's been very difficult. And I don't know many people, if anybody, over the 20 plus years of being in this business that have successfully made a career out of day trading or very short-term trading like that. So I just steer away from it. And again, most people watching this should not be doing that because it's just not their full-time job. And it's very, very difficult to do. You have to, first of all, learn to get your emotions out of it and going from there. But my point is, if I see a stock or a company that I think is a nice long-term buy, you know what? Let's talk about it one. Let's get into our list right now. So here's a chart of NIO, N-I-O. Most of you have heard of NIO. It's sometimes referred to as the Tesla of China. It's one of the bigger electric vehicle companies in China. The numbers have been amazing. I've owned the stock in the past. I have no exposure to it now. And again, none of this stuff's buy or sell recommendations. I don't own any of these stocks. But look at this chart. We talked about these double bottoms. Big support from there in May. Had a nice little tail today. This could be a bottom. We have the RSI all the way down at 10, really beaten up. But the reason that I like NIO is more than just the chart. This is a company that is one of the leaders in electric vehicles. It is a company that is a leader in a mega trend in a country that is really pioneering this mega trend of electric vehicles. So for me, there's a lot of great opportunities. $51 billion company that, again, is well off the highs. I just showed you the chart. Last year did $2.35 billion in sales. This year, the estimate's for $5.62. So even though it's gotten beaten up, sales are expected to grow well over 100%. By 2023, sales estimated at $14.5 billion. Based off that, we're trading at about 3.4 times sales in 2023. For a company that's growing this fast, I hate to say this because people think I'm crazy, it's cheap. It truly is, especially compared to like some other companies like Tesla, which we'll talk about here in a minute. It lost 66 cents a share last year. This year expected to lose 31 cents a share. It should turn its first profit in 2023, about 34 cents a share. So again, it's not highly profitable, and even though it's not a small cap, it is still an innovation growth company that is in an area that is reinvesting all the money that's making, which makes sense to keep up with the demand it will have in the future. But it has to have a path to profitability I always talk about, and this company does have a path to profitability. They do something that's a bit different too than some of the other Chinese and a lot of the US companies. They do what some people are calling, which is BaaS, Battery as a Service. So they have a partnership they just announced recently with Royal Dutch Shell, called Shell. Then they're going to offer these battery swapping stations in China and throughout Europe. What's different is instead of pulling into a charging station, plugging your car in and letting it charge, you go in and it's very easily. I've seen videos of it. You swap out the battery and put it in and take off. And then that battery charges for the next person to come around. Obviously, there's many, many batteries in this charging station. But boy, does that make absolute sense. And they're the pioneer in this. So you add that extra layer to it, it makes it even less expensive based on evaluation-wise, in my opinion. So really 3 big things come out of this partnership. And keep in mind, Royal Dutch Shell has the most service stations throughout the world. So imagine if they fit these with this technology. Think about that. Because eventually, you're not going to have gas stations on every corner. It's going to be charging stations, potentially battery swapping stations, as Shell is such a leader throughout the world with the largest amount of service stations around the world. This is a big time announcement. This was last week and didn't get much press at all. They're going to work on battery technology together. That's going to help Shell because really NIO is the leader in that. They're going to co-brand these stations, and by 2025, they want to have 100 of these in China. Next year, we're going to start the pilot program in Europe, which is very, very exciting. And again, like this could be something where you look at a Royal Dutch Shell. You know, obviously this is an oil company. It's more diverse than that, but it's an oil energy company. I could see some of these bigger companies such as that snatching up some of these other companies that have battery technology. It makes perfect sense to me, NIO being one of them. I would never buy NIO based on the takeover. It's already a $50 billion company. It doesn't mean it can't be a 10Xer in the next 10 years. That definitely could be. But I would never buy it because I thought it was going to be taken over. But again, it's an example of a company that to me is just sitting there and is flying under the radar, even though it's a well-known stock and is a great value at this point. So number 2, let's take a look at Marathon Digital Holdings, symbol MARA. So Marathon, as you probably know, is in the business of mining digital currencies, a lot of Bitcoin in there. And you can see in the chart, it rallied up to above 80, came all the way down, lost half its value in less than a month, folks. Sitting on a 200-day, which is the blue line here, it's been great support in the past. It's sitting there, a lot of price support in the 30-40 area. Hit a low on Monday of 38.01, closed at 42.17. So big, big turnaround, even though it was only up 1.3% on the day, big turnaround at the bottom. Wait till you hear some of the numbers on this company. I mean, this company is very much set to grow. It's a $4.2 billion company now, so it's a mid-cap company. Revenue last year, only $4.35 million. This was just $4 billion, $4.35 million. This year, looking for $186 million. Just think about that growth. By 2023, estimates for $915 million in sales. That means in 3 years, it goes from 4.35 to $915 million in sales. That's what, 200x. Last year, it lost 13 cents a share. This year, looking for a profit of $1.43. By 2023, again, it's almost 2022. So when you hear 2023, it's not that far out. Estimates are for $5.37 a share. You put that at 20x multiple, which is cheap. If it hits this number, it is absolutely cheap. You know, 20x multiple, it's what, $107 a share, give or take, and it's at 42 today. And that'd be in 2 years. So that's a heck of an upside there. The wild card here it is, this company and the performance of the numbers I just talked about, the performance of the stock that we just saw on the chart will be extremely, extremely dependent on guess what? The price of Bitcoin and the price of cryptocurrencies. So if they falter, as we saw Bitcoin and cryptocurrencies pull back in the last week, especially this weekend, Bitcoin fell from just 59,000 just about within 2 weeks past to 42,000 and change over the weekend. As of right now, it's getting about 49,500. And so it's got well off the lows, still well off the highs, extremely volatile as of late. I personally, I look at it and I don't like to wake up and see like, holy smokes, what happened overnight? That being said, I'm a long-term holder and I still believe 100,000 is extremely, extremely achievable in the near term. And I think much higher is achievable as well. So I'm a long-term holder. That's the strategy I take. I can't let these pullbacks freak me out, because if they did, you'd be sold out of Bitcoin 3 times this year, because there's been 3 times when Bitcoin's pulled back at least 35% this year alone. And keep in mind, last year, Bitcoin's still up well over 100%. Best performing asset class out there, folks. So you got to keep that in mind. You have to put everything into perspective. So let's take a look now. We'll take a look at Tesla. We'll go back to the electric vehicles. I like this because I think Tesla is going to be a huge winner when it comes to battery storage. What about Tesla insurance? They're going to start offering insurance for the cars, especially when they become autonomous vehicles. Really, I think Elon Musk is cornering the entire transportation industry here, the entire energy storage industry, solar, throw that in there. I just think there's such upside. Battery technology, sure, it's about 900 billion and change market cap, fell back below the 1 trillion. But I still think this is a multi-trillion-dollar company by the end of the roaring 2020s. So I think there's still upside. Pulling back from over 1,200, big support here at 1,000, which is psychological level. It's a price support level. It's a 50-day moving average. I think it could fill the gap down here at 900. If that were to happen, it could even come all the way down to 800. Anywhere in here, boy, I would be an aggressive buyer. I think there's a lot of upside if we come down there a little bit lower. It doesn't mean that we're going to. It could hold right here. But if it were to come down a little lower, it wouldn't surprise me. But a $980 billion company right here. Did sales last year of $31.5 billion. This year looking for 51.2. So obviously really nice growth. By 2023, $91 billion. And again, you look at 2023, it trades at about 10.5, 11 times sales. Again, that's expensive, but compared to some other companies out there, high growth companies, it's not as expensive. And again, I think they underestimate the upside potential of battery technology, battery storage, Tesla insurance, autonomous vehicle, ride hailing systems, so many things I think that are underestimated that will come to fruition in the next 5 to 10 years. Last year, they made $224 a share. This year, looking for $615. So again, great bottom line growth. By 2023, looking for about $10.83 a share, $10.83 a share. So again, not cheap by any means, folks. I'm not trying to tell you it's cheap. But on this pullback, I think if you've been looking to get into Tesla, it's not a bad time to give it a little shot if that's what you're looking for. But again, keep in mind, it could easily pull to 800 and still look great in my mind. So, that's what you have to realize. So the next stock I want to take a look at is Cloudflare. It's a cloud platform company, symbol NET. And this is a company that I find interesting. Great chart. It was just at an all-time high a couple weeks ago. As you can see here, it was up around $220 a share. And in that time frame, just these last 2 weeks, closed down on Monday down 7.8%, down over $12 to 147.25. So big time pullback, over $70 in just literally 2 weeks. Again, this could pull all the way back to 120, where there's some consolidation in the 200-day moving average, and still look great long-term on the chart. So I'm not saying, again, you don't want to catch falling knives. There's big volume on the downsides here, lighter volume on a one-up day in these last 6 days. So yeah, we may still see some more downside, but again, it's the type of stock that I want to show you that I'm looking at, what I see in charts and what I see, these, again, I'm talking a lot about the charts, but these all met my requirements of being in a mega trend, being leaders in that mega trend. So it's not just the charts. These I would like to show you along with it. But $47 billion company. Last year, $431 million in sales. Looking for $646 this year. $1.2 billion around, give or take, in 2023. Lost 12 cents last year. This year, a small loss. First profit should be in 2022. So again, path to profitability for this company. The next two are a little bit smaller, and this is a company called Porch. I'm pretty sure I've talked about this in the past. It was a SPAC back in the day. Porch Group, PRCH is the symbol on this one. And you can see here in the chart, here was a SPAC, didn't do much, but it's been choppy and had a really nice run here, October into mid-November, nearly doubled, well, above 27 cents a share. $27 a share. And then we had a downdraft of about 10 straight days down. We broke that today. The RSI is down at 9, extremely oversold. A lot of support at 15. If it came back down there again, I think it looked absolutely fantastic. But this is a company that's pretty interesting because it is smaller. It's still, it was a SPAC, so people don't like that. About a $1.75 billion company. Is a software platform that supplies home services to people. It could be individual homes, it could be condominiums. If you want to try to find an inspector, you go on there. All types of stuff connecting, basically make your home smarter. Sales last year of 72 million. This year looking for 195 million, so big gain there. By 2023, 400 million. So big growth based on 2023, trading just about 4 times sales. Again, for a company like this that can scale, software type company, that's a really nice valuation. Last year lost $1.74. The next couple of years, it's looking to lose around 50 cents a share the next couple of years. I do see a path to profitability, probably a little bit later, roaring 2020s, not quite yet. So that's something to keep an eye on, that they can definitely turn a profit with this business. So it makes it a little bit more risky. But again, based on a chart, based on what I see, very interesting company. And the last one that I want to talk about here, this is PGNY is a symbol of progeny. And this is a company that you may have heard me talk about in the past. It does fertility benefits, and it's been a big thing. A lot more women freezing their eggs, using clinics and benefits to try to achieve childbirth and with fertility issues, as people are getting attempting to get pregnant, and family formation is at a later age in life, running into some issues. And this company looks to help with that. So it's about a $4.3 billion company. And as you can see in the chart here, it was at an all-time high again, like a lot of these stocks just last month. Pulled back from nearly $70 down to the mid 40s. We closed at 49 on Monday. It's nice. We held this level. We held this level. We filled this gap. So a lot of nice things on the chart. Volumes in big, except for one day there on the upsides. And again, I like where this company is as far as the mega trend that it's in. This type of mega trend isn't the most exciting, fertility. But you look at sales. Last year, 344 million. This year looking for 509, and that's even with a lot of people not being as interested in fertility because of still COVID hanging around. Then we have 2023 looking for 1.06 billion. Again, trading about 4 times sales. That's, again, these companies have become down to levels that are not extremely expensive anymore. Last year they made 18 cents a share. This year looking for 60, and 2 years from now looking for $1.10. Big top line growth, big bottom line growth. In a very niche area. It's a mid-cap company in a trend that I believe is not going anywhere. And this is the type of company that can help really with your portfolio and diversification, because without having everything in pure tech, looking outside of that, but still having exposure to growth, which we want to have exposure to growth and being companies that have potential to be big winners and be the leaders in their area. And Progeny falls into that. So, we talked about a lot today, folks. We talked about the market sell-off. We talked about how the tech stocks have gotten hit. We took the little chart lessons. We look at the contrarian view, how just everything's so damn negative. And usually when you see that, that's time to be buying, in my opinion. Again, long-term buying. We don't know where the bottom is, long-term buying. Then we talked about, obviously, a few stocks. I think we talked about, 6 different stocks, a little 6-pack of stocks for you to put on your watch list. No buy or sell recommendations. I don't own any of these stocks, but I think it's something to take a look at. I think you want to start building out your watch list right now, especially as we get close to 2022. Maybe you get the watch list for 2022, get it all ready to go. But on a side note, I'll be back in the United States here later this week. So we plan on doing a Thursday show. Going forward, we'll show every Tuesday, Thursday from the studio that we set up in Stansberry Research in Baltimore, Maryland. So hopefully we'll be back Thursday in the studio. If not, we'll be back next Tuesday. But as of now, we will see you Thursday. Again, think big picture, think long term. Don't let these wild swings get you all, worked up, because there's nothing you can do about it. And again, we're here for what? 3 very important things, folks. We want to have fun. We want to educate the heck out of you. And we want to make some darn money. Again, I'm Matt McCall. You've been watching Making Money.